The majority of work on secular stagnation and with it the debate regarding bond market valuations, fails to consider the deeper historical rate trends. In contrast, a multi-century dataset offers the opportunity to look at cyclical behavior and the dynamics of reversals from earlier real rate depressions. In this spirit, this post provides a real rate dataset for the last 700 years, and identifies a total of 9 real rate depressions sharing similar traits to the trend observed since the 1980s. The all-time real rate average stands at 4.78% and the 200-year real rate average stands at 2.6%. Relative to both historical benchmarks, the current market environment thus remains severely depressed. The 700-year average annual ex-post headline inflation for the risk-free issuer stands at 1.09%. The 200-year average, since 1817, stands at 1.55%, with a further pickup in the 1900s. 3 observations stand out. First, the past 60 years, in which the U.S. has been the benchmark bond issuer, has been the most inflationary in our whole sample period. Second, current inflation rates of slightly below 2% remain fully in line with the ex-post performance witnessed in modern times, with today's typical inflation targets already being accommodative if measured against very long-run trends. Third, never before has a longer period without deflation existed than the ongoing 70-year spell since World War II. Real rate depression cycles. Focusing on our cyclical precedents, on several previous occasions, rates have exhibited a sustained divergence from long-term averages. Over the 7 centuries, real rate depression cycles, which saw a secular decline of real interest rates, were followed by reversals. Our current secular stagnation of real rates, at 34 years, is the second longest thus far recorded. Only the years immediately surrounding the discovery of America outstrip the current cycle by length. Measured by total rate compression from peak to trough, the period from 1325 to 1353, at 1700 basis points in real rates, is the most notable. In our 7-year moving average dataset, the all-time trough within depression episodes is recorded in 1948, at -5.3%. Turning to how these depressions end, the chart plots the path of real rates in each reversal period following the trough. Most reversals to real rate stagnation periods have been rapid, non-linear, and took place on average after 26 years. Within 24 months after hitting their troughs in the rate depression cycle, rates gained on average 315 basis points, with 2 reversals showing real rate appreciations of more than 600 basis points within 2 years. On aggregate, then, the past 30-odd years more than hold their own in the ranks of historically significant rate depressions. Looking at past cyclical patterns, the evidence suggests that when rate cycles turn, real rates can relatively swiftly accelerate.